I started as a very young man. I was 9 years old when I started washing dishes and working in my dad's restaurant. So you learn the value of a hard day's work.
Welcome, everyone, to our Hero Capital Show. I'm your host, Tim Mai, and today we have an amazing guest on the line with us, Mr. Matthew Ricciardella. I hope I pronounced your last name correctly there.
You did a great job. Good
Thank
pronunciation.
you. Yes, and Matt is the founder and chief executive officer of Crystal View Capital. With 20 years of experience in real estate industry, he has personally been a principal in over $1 billion worth of real estate transactions, and presently has over $600 million in assets under management across various funds. And Crystal View Capital is a value-add real estate fund which focuses on acquisitions and management of self-storage and mobile home communities across the U.S. Matt lives in Las Vegas with his wife and two children. He is actively involved in the local community as well as various charitable foundations. So with that, everyone, let's give Matt a huge Texas welcome, y'all. Woo-hoo!
All right. I like it.
Yes. All right. So you can share with us, Matt, a little bit about your journey. How did you get into our war here of real estate and especially into this real estate syndications funds industry?
Yeah, I'll try to make it brief, but give you a flavor of my background. I grew up in upstate New York, actually in the Catskill Mountain region, if anybody knows where that is. And my family was not in the real estate business. They were in the restaurant business. But a lot of good things came of that. I started as a very young man working in that business. I was 9 years old when I started washing dishes and working in my dad's restaurant. So you learn the value of a hard day's work very early on, which is, I think, a characteristic that I transfer into what I do today. And I try to build that entrepreneurial spirit and that hard work ethic within my team and anybody I come across, pass across with. I started there, didn't really have much of a background in terms of an education, dropped out of college, moved out to Southern California when I was pretty young. I was 20 years old. And I thought to myself, what could I do that I could earn a lot of money without a degree? And I thought, boy, real estate would be great. So I became a
Mm,
residential realtor. I got licensed and everything and began selling homes in Southern California in the Long Beach area back in 2002. During
great
that,
timing too.
yeah, no, it was fantastic timing. The way I built my business up, didn't have any contacts, didn't have any relationships. I one day watched a sales training program about making cold calls and prospecting to owners and sellers. And that's how I built my business up. So I picked up the phone. I made, I don't know, 100, 200 phone calls a day, cold calls, knocked on doors, put in the work, and then slowly but surely started to build up a business. In the beginning, it was very tough and didn't know where I was going to get my next meal for a while. It takes a while until a commission check closes. But once it did, it really started to roll in quite nicely. And I found myself being a relatively young man, 22, 23, and making $400,000 a year. So it was fantastic until one day I cold called somebody and they said, why don't you just buy my property?
Mm.
Why list it? So I ended up thinking to myself, how am I going to buy this? I had no credit at that time, but this is during the day and age when they were giving out loans to babysitters. And there's ninja loans and stated income and all of that. I was one of the recipients of one of those loans, bought a property, flipped it a year later, made 300,000. And I said, I'm not going to list homes
Nice.
anymore. I'm going to become an investor. Started getting in the flow of buying multifamily, office, retail, industrial, all through cold calling, building up some
Wow.
relationships, buying properties, using the little amount of capital that I had, bringing on subordinate debt. And what happened was I fell into mobile home parks and storage because they were very much mismanaged. Mom and pop owned and operated, very fragmented, very inefficient market. So I thought to myself, I could make a lot of cash flow. I wanted free cash flow. And those two property types generated more free cash flow than anything else that I invested in. So I said, might as well make my focus here. And it's all mom and pops. So I built that up, did some deals, and thought I'm really on to something. But my capital sources are very limited. So I went out in 2014 and launched our first fund where we went out there and raised outside capital. So
That's,
I'll stop there and let you take it from there.
yeah. So around what year was it that you got into self-storage and mobile home parks?
So I bought my first mobile home park in 2007, bought my
Okay.
first self storage in 2008. So I was around for great
Amazing.
financial crisis. And I'll tell you, Tim, those properties actually did better in that economy. And that's what kind of always has attracted me to those asset classes. They're counter-cyclical, very defensive, and they tend to outperform in down markets.
Yeah, that's amazing. So since then, you just stuck with those two asset classes primarily?
Pretty much. I've bought some other stuff. I bought some retail and some industrial that had like an offshoot of storage to it. But really, by far, 90% plus of what I've purchased over the last 10 to 12 years has all been manufactured housing communities and self storage.
That's amazing. Yeah, with you starting out around that time 2007 8 start buying self-storage and mobile home parks, I'm pretty sure because at that time institutions really gotten into that space much yet, and you had a really good run up there. How is that market now? Are there much mom and pops left unless you go very small, or what has changed in that market in those two asset classes since you've been in it?
Yeah, so a lot has changed. When I got started, to your point, it was very illiquid. There was not a lot of institutional capital. There was not a lot of debt providers. So, it was very challenging to capitalize deals. You had to get seller financing or you had to have all cash. I didn't have all cash, so I basically relied on seller financing, creative financing structures, lease to owns, worked with local banks. It was very challenging. There wasn't much capital in the space, but returns were fantastic. You're talking 10, 11, 12 caps, just unheard of. Fast
Yeah.
forward today, the tables turn and it's all relative, right? So you've got a lot of liquidity chasing both asset classes, institutional capital, PE shops. They very much want exposure, understandably, to both property types. Then on the debt side, you have Fannie and Freddie that are the best lender that you could use, providing a lot of liquidity to these asset classes, very cheap debt capital. So it's made it very challenging and it's compressed cap rates significantly. But to answer your other question, there's still a lot of runway left. I think more than 50% is the stat I last saw of these two property types are still majority mom and pop owned and operated.
Oh,
So
wow.
I see the next 5 to 7 years plus as being a real opportunity where we can continue to consolidate, to aggregate and roll up both of these asset classes.
I see. Okay. And what size is your buy box?
The larger, the better. Mostly what we're doing right now is manufactured housing. We're not buying much storage. The reason being is that the revenue growth and the occupancy growth is unbelievable right now on manufactured housing. We're growing rents by 7 to 10% a year on average. We continue to fill vacant sites at a clip that I haven't seen in my career. The need for
Wow.
affordable housing is off the charts.
True.
What makes this asset class, the manufactured housing, different from the storage is you can't build any more of it. No municipality wants to see mobile home parks being built, but the demand and the need for affordable housing is higher than it ever has been. So those that own this asset have tremendous pricing power. On the storage side, you could come in and you could build a new facility pretty easily. On the multifamily side, you could build a new apartment complex pretty easily. So that's why we're really focused on the manufactured housing side right now.
Gotcha. That makes sense because I was gonna ask you. I know a lot of guys who are in the self-storage space have seen like a lot of supplies that enter the market and having challenges to fill their facilities. So that's really good to know that you focus more on the manufactured housing side. And on that side, what would be
The ideal deal size.
the ideal size? Yeah.
Yeah. So again, I was saying the larger, the better, but let me just give you a little color there and some context. We just closed on a deal last week for about 10 million. And that's probably our sweet spot is 5 to 15. We're looking at some deals right now that are in the mid 30s range, a portfolio deal. but we like the larger institutional stuff that's mismanaged. And we feel like
Ah,
what makes us different, Tim, and not to skip ahead, is we're vertically integrated, our organization. So we manage all of the assets that we acquire. So we have a team that's basically on standby. As an example, this deal that we acquired last week, they're already boots on the ground. They're in the community, putting together the value add business plan to turn the asset around, filling vacant sites, bringing rents to a market level. Where could we invest capital to make the community more appealing? And the reason why we do that is no third party is going to care as much as an owner is. And it creates a tremendous bond and alignment of interest between us and our limited partners. And frankly, we don't believe anybody could do it better than us anyway. When you have economies of scale, like a larger deal, and you do one rate increase and say it's $50 and it's 400 units, that goes a very long way versus 50 units. So if you think about the value creation there, you're talking about millions of dollars by one rate increase versus on a smaller deal, it just takes you a lot longer to get there. And we have pretty significant capital available to deploy. And because of our track record and our brand and our reputation, we constantly have new capital coming in. So we're looking for larger deals to deploy that capital in so we could generate outsized returns to our partners and our investors.
your business model, is it all park-owned homes?
No, the least amount possible. Now,
Okay.
you end up like the deal we just bought last week. I think it was 208 occupied sites. There was 3 park-owned homes that came with it. So very
Oh, wow.
insignificant
Okay.
portion. There are some, we have bought deals that are 100% park-owned homes. But what we do, Tim, is we look to convert those over to lot rent only. And the reason why we want to do that is we want to shift the repair and maintenance burden off to the tenant, where we're not, because otherwise it's being in multifamily. A sink gets
Right.
clogged, a roof leaks, they call us. We don't want to do that. One of the beauties of being in this business is you're just leasing spaces. The home is their responsibility. Your repair and maintenance is very light compared to other asset classes. You're just maintaining roads, infrastructure, things of that sort.
I see. Okay. And at the deal size that you're talking about, it sounds like they are much nicer parks than most of the ones we see. Like here in Houston, it's hard to find a good looking park in Houston. Like most of them are very rundown, very like small. So it sounds like the ones that you deal with, like you said, what you're buying from institutions, and so they're probably much nicer parks.
Yeah, just to qualify, we're definitely not buying from institutions. Mostly
Oh,
targets are mom and pops. We're selling to institutions.
gotcha.
So our MO is find the mom and pops that own an institutional quality asset that
I
aren't
see.
managing it to its maximum potential, buy it off market through our in-house sales team, which is very active in building relationships and creating off-market deal flow. Once we maximize that NOI and stabilize that asset, then we typically go out and sell it to institutional capital for a premium. So we're making that pretty nice spread. And then we're generating some pretty significant free cash flow that's allowing us to service an 8% preferred return to our investors all the while during our ownership.
I see. Okay, that makes a lot of sense. And so even at that level of a deal size, you're still finding good amount of mom and pop like own parks?
This last one was very mom and pop. They've
Mm.
owned it. This gentleman's father built it about 35 years ago, and they've owned
Wow.
it all those years and grew up in the park. And a lot of times, I'll
Wow.
tell you, Tim, it's not always who could strike the largest check. It's who's going to be the best steward for the asset. There's an emotional tie and a connection, and they want to see it go into good hands, not your typical Wall Street financial engineer who's not even going to view the asset, who's just there to generate a return for their investors. Not that we're not out to do that as well, but we show them that we take great pride in what we do. You know, we invest back in the community. We have relationships with the tenants. We want to make them proud that they sold to us. And that goes a very long way. A lot of times you could buy assets for a price less than where they would trade in the market if you identify and position yourselves as an ideal steward. And that's what we've become very successful at doing over the years. And
That's
our
excellent.
and our partners have reaped the benefits of that.
That's excellent. And what market do you buy in? What states?
Yeah, so we're pretty agnostic to a geography. We're in 32 different states right now. I would
Oh,
say we
wow.
have more of a focus on Midwestern states, Wisconsin, Michigan, Ohio, Indiana, those states. But we're in Connecticut, we're in California, we're in Washington State, Florida, everywhere in between. So, really, for us, it's about a story, a special situation, a seller that needs out, that has an underperforming asset that we could come in, buy and turn around pretty quickly and stabilize. And
I
it
see.
for us, we didn't want to pigeonhole ourselves into a market to do that. We wanted to open and broaden our horizons to the most opportunities possible.
I see. Okay. You know how in the multifamily space, a lot of operators tend to go with landlord-friendly states. In your case, since you're just renting out the land, I assume the laws for that is landlord-friendly no matter where you go. Is that correct?
Unfortunately, not necessarily. We're still subject to rent control in several states, namely New York, California. There's rumblings that Pennsylvania is rolling out rent control. Oregon and Washington just did. So some of these ultra blue states, you are subject to rent control. You can't go beyond 3% in certain instances on your
I
rate
see.
increases. I see a lot of flight leaving those markets. We're not opposed to buying in those markets as long as we're pricing in the rent control, the cap on the increases. And we have a team that really knows the regulations. And we already own in New York, we own in California. So we understand some of these regs. Our team is very educated, up to speed on them. So we'll step in if we could get the right deal and generate a return for our investors.
Let's talk about your funds a little bit because you have had a number of different funds. Are they all multi-asset funds?
So they're all dual strategy around storage and manufactured housing. Our first fund has gone full cycle. So we've sold off all of those investments. And we were actually ranked by Preqin, which is a third party rating agency, as the number one private equity real estate fund in North America at that time. I think
Wow,
it was 2018, 19, but it was a 47% return in that fund.
amazing. And yeah, explain your funds a little bit. So do you have both self-store, like both assets in all the funds? Is that what you were saying?
Yes, it's a dual strategy. And the reason why we do that, I'll tell you, we get this question often, Tim. It's the best of both worlds, is what we tell our investors. So on the storage side, you get a lot of free cash flow. These very light repair and maintenance, CapEx, overhead. So these properties generate a lot of cash flow. It's not atypical to generate a 10% plus cash on cash return pretty quickly when you buy a storage asset. You know how to manage it, you buy it right. On the manufactured housing side, it's residual pop. And what that means is when we go to sell it, typically we could command a premium in the marketplace just because
Hmm.
very limited supply. If you've got an institutional quality asset, you're still going to be selling that in the 5 cap range today, believe it or not. So when you marry together the cash flow that the storage gives you and then the great exits that the manufactured housing gives you, it's the best of both worlds in that sense.
I see. That's amazing. And typically, how many assets do you put into one fund?
Depends. Right now, we have about 22 assets in our fund. We've raised about 100 million in equity capital in that fund. I would anticipate by the time we're done, it's probably going to be in the range of 50, give or take. If we do buy some larger assets, it could be less, 30, 35, something like that. But I would say anywhere from 30 to 50.
Okay, so it's based on the fund size. So in this case, fund four, it's 100 million. So however many assets you're able to buy with 100 million, is that correct?
Yes, and we've already deployed all of
Oh,
the equity capital that we've raised. Our deal flow is so strong. As that equity comes in, we're deploying it almost immediate because our pipeline is so strong for new opportunities right now. We still have another 100 to raise in Fund 4, but we are planning to close that fund out by the end of the year.
I
So as
see.
quickly as we raise that equity, we're going to be very disciplined in our approach. And if we don't have a great opportunity to deploy it, we're going to wait. But because of the deal flow that we've had, we're fairly confident in our ability to deploy it within 30 days or less.
I see. Okay, I understand it a little bit better. So share with us from fund one to now fund four, how you structure your fund and the amount that you raise for each fund has changed as you grew your business.
Yeah, our first fund was a $10 million equity offering, so relatively small. Your first fund is always challenging. You've got to go out there. You don't really have a brand or reputation at that per
Hmm.
track record. So it's really hustling hard, getting in front of people and asking for their trust. And I was lucky to meet some people that took a chance on me, and it paid off tremendously for them and for me, frankly. Our second fund was a $58 million equity offering. We started off as a $35 million equity offering, but because of our performance, it was oversubscribed. Fund three was a $100 million equity offering, but again, because of performance, it was oversubscribed by $40 million. So that was a $140 million raise. And now our fourth fund is a $200 million raise. And I could tell you, well, I have a lot of sponsors or new sponsors come to me and say, "Hey, what's your best advice on how to raise capital?" And my answer is very simple. It's do as you say you're going to do and perform. If you do those two things, you'll have no problem raising capital. And that's the position that we've been in here at Crystal View. So for us, delivering for our investors goes above and beyond everything else that we do. Because when we go out to launch a new fund, our investors know us, they like us, they trust us, and they know what kind of returns they could expect.
That's really good. In the multifamily space, a lot of sponsors have had a lot of challenging deals, especially when they bought in within like around 2021, 22 timeframe. How have your deals been and how have your fund, like in especially in your market? I guess two-part question. How has the self-storage and multifamily, self-storage and mobile home parks markets been during those peaks times? And then how has your fund been
Yeah.
doing? Any challenging deals on your end?
Every deal has not worked out exactly as planned, but I will tell you this, that on the whole, the fund is actually performed, all of our funds for that
Mm.
matter, are performing ahead of projections from when we
Oh,
launched
that's
the
great.
vehicle. There will be a deal, you do enough deals, there's going to be a deal or two that doesn't work out per your initial underwriting projections. But I'll tell you this, our balance sheet is very conservative, Tim. Our leverage right now in Fund 4 is like 25%. In
Oh,
Fund
wow.
3, it's 50% or less.
Oh, wow.
And the
Okay.
reason why we've struck, and we have really no debt that's coming due. Most of our debt is fixed in place right now. So we're in a very strong capital position where we could weather almost any storm. And the reason why we set it up that way is we'd certainly rather be overly conservative rather than overly risky to hit a certain return profile. I'll also say this, we haven't skipped a beat on distributions. We've never missed a distribution in our funds, despite the movement in interest rates, where a lot of sponsors, a lot of our peers and competitors, they've cut distributions or they've frozen them entirely. And the reason I
Yep.
know this is a lot of our investors are invested in other sponsors in our space. And I think the reason for that is overly optimistic underwriting assumptions, buying into assets with variable rate debt with the idea that you're going to grow NOI. And when that didn't materialize, and when interest rates ballooned, you're like in a position where you're going to lose the asset now. So very unfavorable. We're actually looking at some of those deals as a potential buyer right now. It comes back to being a prudent operator, being a disciplined acquirer. If you know how to do those things right, you're probably not going to get hurt, or you mitigate your risk of getting hurt tremendously. And I will just end with this on your question. These two asset classes, fundamentally, I haven't seen skip a beat either. So despite
Mm.
the challenging interest rate environment, we're not seeing operational distress out there. It's not as though delinquency is through the roof, tenants stop paying their rent, there's a huge fall off in occupancy. I'm seeing some softening on the storage side, which is actually starting to stabilize a bit. But I'll be honest, COVID was very explosive for storage.
Yep.
Occupancies went through the roof, revenue growth went through the roof, and that's definitely tapered off. And we're back to a more normalized environment on the storage side, but the manufactured housing continues to grow by high single digit, low double digit revenue growth per year. So these two property types, we're seeing very little or no operational distress.
I see. That's good to know. Do you pay out quarterly or monthly?
Quarterly,
Quarterly.
quarterly, and we're already hitting a full district. Fund 4, which was launched in 2023, I'm very proud of because, again, we're ahead of projections. We're already hitting a full preferred distribution, which ranges from 7 to 9.5%, depending on the respective unit class. And we've made all of those distributions in that short amount of time in a 2-year ramp period. So really proud of those results and our team's ability to execute, add value to assets so we can make those distributions to our partners.
I see. Okay. In terms of the equity that you raise in your fund, what would you say is the percentage that are like family office type of investors, percentage that are other fund of funds managers? A lot of people on this call are actually they do fund of funds.
Okay.
And then what's the percentage that are your retail investors?
Yeah, great question. So let's break that down a bit. We have several family offices. I would say they fall on the smaller side. Let's say $500 million to $1 billion net worth in that range. I would say you're looking at probably 25% of our LP equity is comprised of that. Then you've got probably another, and don't quote me on this, 25% fund of funds. Got a lot of those groups, some of them larger, some of them relatively newer that are just starting out. We love to work with fund of funds. And then probably 50% are just your retail investors, whether they're part of an investor group like Hero or there's various others out there, or if they're just a kind of a one-off investor. I will say this, I think it's important to notate probably 5 to 10% of our limited partners are former sellers. And the reason why I think that's important is it speaks very highly of how we operate as a deal partner. We tell sellers the truth. We create win-win scenarios for them. We do what we're going to say. We don't retrade unless there's something material that takes place during that transaction that wasn't disclosed to us. As a result of that honest dealing, once we close a deal, a lot of sellers come back to us and say, hey, I had this great liquidity event. I don't know where to put my capital. You did exactly what you said you were going to do. I got to learn a little bit about you during the transaction. I got to learn about your company and the returns that you deliver. I'd like to turn around and write you a check back. Is that okay? So we see a lot of that take place. And then finally, last but not least, I put a lot of my own money in these deals, Tim, as a limited partner. And I don't get any preferential treatment. I invest on the same terms that you would or anyone on this call would, for that matter. And I do that because I think it creates a very strong bond and an alignment of interest and trust. And secondly, to be honest with you, for selfish reasons, I don't know where I could get a better risk-adjusted return.
That's good. Hey, betting on yourself. That's amazing.
That's what it's all about.
Yeah. So with it being a fund structure, especially those sellers that have a liquidation event, are they able to 1031 into your fund somehow?
Great question. They can't 1031 into the fund. Again, let me back up first. I'm not a tax advisor. I'm not a CPA. So I want to put that disclaimer out there. With the knowledge that I have, the answer to that question is no, because a 1031 exchange is like kind. So it'd have to be real property. A LP position in the fund is considered a security. So you can't swap real property for a security. But here's what you can do. And here's what a lot of sellers have astutely done with us. There is another known section of the IRS code that's lesser known, that's very similar, that's section 721. And think about it this way. It's like a stock swap. So you're an owner of a mobile home park, easy math. We both agree that it's worth $1 million. I come to you, Tim, and say, hey, I'd like to offer you $1 million. And you come to me and say, this is very tax inefficient for me. I don't know where to put my money. And I'll say, hey, within section 721, I'll issue you $1 million of stock in Crystal View Capital Fund 4 in exchange for the asset. So we would own the asset within Fund 4. You would own still a piece of that asset by virtue of being a fund LP, along with the other 22 investments that are part of the portfolio. And that's completely tax deferred, just like a 1031 exchange. So you would alleviate yourself of the day-to-day management responsibilities. You'd start generating that 7 to 9.5% cash on cash return, and you'd own a piece of all the deals within the fund.
Wow, that's really good. That's my first time of hearing that. So good to know.
Yes.
I learned something new. What was that code? Section what?
And if
721.
you want some information on that, there's actually a website we've created called cvcequityswap.com. And Ben can provide you, we have some literature on how this works. But if you go to cvcequityswap.com, we created a neat cartoon that explains in detail on how this process works.
Yes, we like cartoons. Make it easy for us to understand. All right.
Absolutely.
Yeah, let's switch gear and talk a bit about capital raising. And obviously, you have had a lot of experience in raising capital, just between not counting the deals you've done before you started Fund One, but yeah, just in Fund One to Fund Four now, you already have a few $100 million raised. And so, share with us your top three channels or ways of raising capital that has proven to work very well for you.
Yeah, look, it's been a variety of sources where it's worked for us. My team has come to me recently. This one actually surprised me a little bit. I've never been a fan of being a public figure. I never really had a Facebook account. I was never on social media, didn't really even understand it, just private by nature, my family and I. But my team has come to me and said, look, you're really missing an opportunity to raise capital and grow the fund unless you go out there in social media, and we'll do it for you. We'll create the content. We just need you to be the voice and the face. When you go out to an asset, you do your due diligence, talk about it, make a short video. When we acquire an asset, tell the audience what you liked about it, why you bought it, what the value add initiatives are there that we could execute upon. And I gave it a shot and it actually worked quite well, Tim. So social media has been a source for us that conveys the message and the theme and the culture of Crystal View out to the broader audience. And I actually have enjoyed that process. And a lot of people have come to us and said, hey, I've been inspired by your message. And for me, that makes it all worth it. So that's been a pretty big source for us. A lot of repeat investors. We still have our Fund One investors that come back to us and re-up in Fund Four. They're in Fund Two and Fund Three and now in Fund Four. A lot of these fund of funds continually come back. Again, I said this before, I'll say it again. It's all about the best marketing you could do is deliver for your investors and do
Yeah,
what you say you're going to do. If you do
yeah.
that, the capital is going to come. So it's through referrals, it's through repeat, and now I would say social media is the third source.
I see. Okay, yeah, that's really good. And you're spot on about like when you're able to do because so I'm a my partner and I would do fund of funds primarily. We don't operate ourselves, and I got lucky in a sense of we got into the space mid of 22, like after all the craziness. So we got lucky and we missed all of those deals that were bought at the height of the market. But I do know funds who invest in those deals, raise money for a lot of those deals, and gosh, like they're at a place where the investors are afraid of
Yeah,
investing because they're, yeah, either losing their money completely or past distributions and capital calls all over the place. So as a fund of funds manager, it's so important that we
you
pick the
choose your
right,
sponsors
yeah, we
wisely.
choose the right, yeah, exactly, because otherwise we can lose our business, especially when that's our core business is vet and choose the best deals that we can for our LPs.
Exactly. I understand we're very sensitive to that. And then it's interesting, Ben, who heads up our investor relations department, and we've just heard horror stories because a
Yep.
lot of our LPs are invested in other deals and they come to us and they say, my God, you guys, I don't understand. I'm invested in all these groups. I've had distributions cut or even capital calls, to your point.
Yep.
But you guys continue. You haven't missed a distribution. You're still acquiring. How does that happen? And I think we have a better mousetrap. You know what I mean? We have an ability to find great deals that are off market. We've got an ability to really execute in terms of adding value. And we're very disciplined and conservative in that approach. And you know what? If it's going to cost me a couple hundred basis points of return for my investors to sleep well at night and not to over lever up the balance sheet, I'm going to do that every day of the week because I'm playing the long game. And usually investors appreciate that. And when you come from that kind of frame of mind and that context, it becomes easy to raise capital because people trust you because you continually have executed. So that's the best advice I could give on raising capital.
That's good. Thank you. Yeah. I want to follow up on your social media
Yeah.
strategy there. Are you guys mostly on LinkedIn or are you everywhere?
Yeah, so Megan Lore leads up our marketing team along with Ben. They do a fantastic job. I would say we've built up probably 6,000 emails, people just reaching out, hey, heard about you guys and love to see some literature and how does this work? And so they become a part of our database every time we make a new acquisition. And I don't know if you're in our database, but just to bring things full cycle, that deal we closed on last week, we did a press release this morning. So everybody who's a part of our database received that press release. And then they turn around and reach out and say, wow, that seems like a great deal. Tell me more. I'm thinking about investing. Then Ben will get on the phone. He'll have conversations with those folks. So I think social media is a way to get your foot in the door, but it's just good old fashioned getting on the phone, conveying the message, the theme, the story, the returns, the track record. And if that resonates with folks, they'll write a check. So social media is just a way to pique their interest, to set up a face-to-face or a phone call. And then we work pretty hard to show them what the Crystal View story is all about. And if they want to be part of the family, they can. So that's how it's worked.
I see. And do you guys advertise like on Facebook ads at all, or is it all organic?
I think we tried that, not much success. It's mostly the organic stuff, a lot of LinkedIn, a lot of postings of content, short videos that Megan and Ben have done on LinkedIn have been very successful for us. Webinars, short feeds on a new deal that we just acquired, or we just refinanced a Fund 3 asset last week, pulled out the majority of our equity. We have a 19% cash on cash return on that deal. So naturally, when our audience sees that, they pick up the phone or they email and say, wow, tell me how did that happen? How did that deal work out? It sounds great. What's the story there? And then we'll explain that. And a lot of folks invest as a result of that.
Very good. All right. We're gonna wrap up this part of our interview and open up for Q&A from the audience here. But before we open up for Q&A, for those that want to reach out to you and your team, learn more about your company, I know we have was it CVCE Equity? No, CVCEquityswap.com. Was that correct website?
That's right. Charlie Victor Charlie, EquitySwap.com.
All right. Any other websites or places you would like to send the listeners to?
Yeah, www.crystalviewcapital.com. And then you could obviously reach out to us at invest@crystalviewcapital.com or Ben@crystalviewcapital.com.